Against, because not everyone knows.
Stan Black from Economics, I think that they ought to be going after the guy in London who was writing the credit default swaps and walked off with tens of millions before letting AIG go under.
Anyone else want to comment on that one, Fannie and Freddie? Criminal action?
Was that the question? Was criminal action?
I
Criminal
personally
action.
asked if anyone, if you thought that there would be, if anyone thought there would be an investigation.
But the question itself was, what was the impact of Fannie and Freddie?
No, the criminal. Was there going to be? Should there be criminal charges
That was the
against
add-on.
it?
What do you see as the impact of Fannie Mae and Freddie Mac to the crisis?
I can. Yeah, is this on?
Oh,
Okay. No? Okay. All right. The impact of Fannie and Freddie, we trade those securities, the agency mortgage-backed securities. Those are our largest positions. And that is the agency mortgage-backed market is the largest securities market in the world. Where they ran into trouble was that they started drifting from their original mandate. So, the original mandate was to support housing in the U.S. and make sure housing is affordable. The way that they did that was that a bank would underwrite mortgages to you and to me, and then the bank could hold those mortgages on their books, and then they would have to go get more deposits to support more mortgages, and then they'd go out and write more. Or they could sell those mortgages to Fannie Mae or Freddie Mac and get cash for them, and then go out and do their mortgage business, again, much more quickly than if they had to go raise the deposits to support the loans. So now, Fannie and Freddie had specific guidelines for the types of mortgages that they were going to underwrite. They had to have a certain FICO score and all these different things, loan-to-value ratio. They couldn't be above a certain size and so forth. They did that, and they were very effective at that. But because they had this very complicated private sector setup, they were privately owned, but then they had also this public policy mandate they had to raise capital in the private markets, and so they had to keep generating higher and higher returns in order to keep capital providers, private capital providers, interested. And so they started drifting into riskier and riskier mortgages. And that's where they ran into trouble. And so that's part of what happened that created this movement into this beyond kind of prime mortgages into what's called Alt-A, and then finally into subprime, that a lot of people were rushing into these markets and making loans that shouldn't have been made.
And they were pushed as well by the government.
Maybe just, I'm not an expert in criminal law or housing, but I am one of the law professors here. I can't help but notice a political undertone to the question, which is that Fannie and Freddie are the bad guys, which has gotten a lot of political play, and nobody else is at fault, even fraudulent fault or criminal fault. And that is not true. I mean, Fannie and Freddie, there may be people there who violated their underwriting standards, and to the extent that's true, they should be punished. They were hardly alone. There were huge amounts of capital coming in from China and the rest of the world looking for places to invest. And countries like Countrywide would come up, private entities, and they started just finding a way to get people to buy into things they shouldn't have because they could then securitize them up into the market where all this Chinese money was going to come. And what they were selling was fraudulent. They were basically selling, I've heard it described as something, what if you bought a toaster, and the toaster, here's a toaster, there's a 1 in 5 chance it'll catch on fire soon. And then they quickly show you a schematic and they say, see? And then they close it up. That's the fine print. Normally speaking, we don't allow that. We don't allow unsafe products to be sold, and we regulate it. This was relatively unregulated. People were selling, just trusting on the market, things that were going to blow up and that no one could appreciate, and they were profiting from it, and they knew it. And no sooner did they get the money than they passed it up the chain to the fancy securitizers who took the Chinese money, and then they went on to the next sucker. I don't know about jail, but there's a lot of fraud going on.
Our next question is for Mr. Flood or Professor Conrad. Can you speak to the role or effect of mark-to-market accounting and its impact on the crisis? And I would add, what do you think of suggestions to get rid of mark-to-market accounting?
Do you want to take it?
I'll start out, although I'm certainly not an accountant. We tried to get an accountant from the business school here today in anticipation that that question would arise, but they are convenient. I'm sorry? They were conveniently at a conference this weekend, let's put it that way. But I think mark-to-market accounting or fair value accounting makes sense in a lot of ways. I think that you need some type of judgment, if you will, about what those assets are worth, particularly if you trade them on a day-to-day basis. I think the issue is when the markets aren't there, when there's no trading volume, when the prices that you can get or the quotes that you can get from the market aren't reality. Now, I think there are rules, that there are judgments that managements can make in those cases that take the place of market prices when market prices are not available. I think it could be, there's a distinction between a regulatory problem and an auditor's problem here. And I think that the regulators might have liked and could still, and in fact they've clarified and they've issued new guidelines to make sure that management is aware that they can use their judgment in certain situations. But I think that auditors, it has to pass the auditor standards too. And so as long as auditors are sticking to the mark-to-market rule, I think that firms don't have as much choice about using market prices as they would normally have. So I think there's a distinction between a regulatory rule and an auditing rule here that's important.
Yeah. Yeah, so the FASB and the SEC are now in discussions with industry about providing some relief on this rule, because as Professor Conrad was saying, the reason that the rule came about using mark-to-market was that people were using historical cost accounting to try to reflect what the economic value of assets was. So they were looking back to try to say, okay, the prices are based on prices where we bought them. But as prices change week by week and year by year, looking back was no longer giving good reflection of economic value. So they said, you got to go to using market prices. And market prices, as long as markets are functioning, are a good reflection of economic value. But when markets stop functioning, then using market prices no longer gets you the purpose of the whole thing, which was to get a good reflection of economic value. And so the FASB and the SEC are now saying, all right, banks, if the market is not giving you the right values, you can have some flexibility in how you mark these assets by using your judgment. And I think that is fully appropriate to do.
Okay, this question for anyone on the panel. What, if anything, could the federal government have done to prevent or at least ameliorate this crisis? Stan? Anybody?
Well, I already indicated that it was forecast, and Alan Greenspan could have had the Federal Reserve take action on the mortgage broker issue. There was a law called Popo, which permitted the Federal Reserve to regulate the mortgage markets in a way much better than what they did. Now, Ben Bernanke has since started movement in that area, and I think they are now doing things. So there's no doubt but what Alan Greenspan could have done something.
And another thing that could have been done, going back to what Gene was talking about, was going back to the early 1990s when the decision was made to allow a lot of these over-the-counter derivatives to exist. As Gene mentioned, one of the solutions that's being talked about now is to require a centralized exchange and centralized clearing agent for a lot of these derivative transactions. That was law back in 1990. And if that hadn't started to erode and then been completely eliminated in the year 2000, then that might have done an awful lot to have not eliminated the cause of the crisis, but certainly would have eliminated the magnitude of the crisis.
I guess I'd like to say one more thing, and that is, I mean, to a certain extent, you can't ask either the markets or the federal government to be able to forecast everything. I think one of the sayings I've read recently is when you've seen one financial crisis, you've seen one financial crisis. And I think all of them are different. I mean, to a certain extent, these products that we're talking about, and I think Chris showed this in the data, subprime mortgages weren't even acknowledged as a big segment of the industry until in the last 2 to 3 years. I think credit default swaps are also a new innovation. I think unless we want to stop innovation, which doesn't strike me as a particularly good strategy either in economics or in regulation, I think we can at best hope to learn about what we've done wrong in this particular setting over the last decade or so, and then make sure that doesn't happen again. And try to do what we can, certainly to forecast what might occur down the road, but acknowledge that unless we're better forecasters than we've been, that's not going to happen. And then sooner or later, there will come a new innovation or something else, some other risk that we've not perfectly forecasted, and it will create another downturn.
I would actually second exactly that sentiment, and I would point out that securitization and derivatives play a very, very important role in our financial systems and in credit transmission and everything else in our economy. So those certainly got out of scale, and maybe were poorly regulated, and we're certainly seeing the expense of that. But it's important to recognize that these innovations play an important positive role too. I think that point was made earlier. And so do you want to absolutely quash this entire exercise from the beginning in the interest of smoothing out crises and smoothing out business cycles? No, because you eliminate the upside, and in particular you eliminate the things that may facilitate long-run economic growth, which, by the way, is what all of us need, because guess what? We have much bigger fish to fry, and that's related to some other long-term instabilities and challenges that this economy faces. So we do not want to eliminate innovation, and with that necessarily will occasionally come these kinds of things. That's just unavoidable.
I wonder if I could ask Richard to weigh in here briefly. In the discussion that we've been having about, of course, we want to preserve financial innovation, and yet it seems that for so long, for most of the century, we've been talking about economics in terms of Keynes or Milton Friedman. And I'm just wondering, are we ready for a new economic theory that considers markets and models markets in a non-linear way that takes into effect their complexity? We know markets are complex. We know that new innovations will come around, new innovations will arrive. Why can't we model that? Why have economists not been able to sort of get to that? And do you have any, if you could comment on that?
Well, really only in a limited way. In terms of monetary policy, each decade brings different problems, and we turn as a profession to those problems. And so after the 70s, with the high inflation in the 80s and the 90s, in monetary policy we turned to the problem of what's called getting the mean right, getting mean inflation right. And so our models move towards controlling inflationary expectations and targeting inflation in many countries, like the ECB does that, the Bank of England does that. And we tended to turn away from the role of monetary policy as a shock absorber, as trying to help the economy absorb the shocks that they hit. And our models turned away from that. And so they tended to, in fact, throw out the financial sector from a lot of monetary policy. And now I think what's going to happen is in monetary economics is that we're going to revisit we're going to bring back models that have richer financial sectors and talk about things like credit that Ben Bernanke spent much of his career working on. So I'm not sure we need a it would be nice if there was a completely new theory and we didn't sort of cycle between having Milton Friedman's picture in the newspaper a lot, and you look at the Times today, John Maynard Keynes is there. And I said to my wife, you know, old Maynard's got his picture in the newspaper again. She said, well, I've been seeing that all over. That, you know, Keynesians are back. So, you know, I hope that we evolve and that we don't just go back and forth. But I think in some sense we're going to go back. We're going to go back to models that try to deal with the credit issues in a more realistic way.
Stan, did you want?
I'd like to just say that there is a part of microeconomics that deals with incentives. And I think that and information differences and the way that regulations may be structured, and I think that part of economics has got a lot to say about the incentive problems that led people to do wrong things.
Sticking with economics for a moment, a person in the audience wants to know, how do you cope with inflation if the government bails the economy out?